Welcome to this episode of Next Exit. Today I'm blessed to have Neil Hodson, multi-time CFO and COO of both public and private companies. Neil, welcome to the show.
Delighted to be here. Thank you very much for having me, Dan.
Also, before we kick off, it would be great to hear, in your own words, a background to you and your career and how you got to where you are today.
I suppose if I had to sum up my career, it's really been about helping businesses through turning points. I started out in private practice, which gave me a solid finance grounding, but I quickly realised I wanted to use that knowledge to shape businesses, not just report the numbers. From there, I moved into industry, first with division of Rakel, where I looked after a number of overseas subsidiaries. Then I moved into Panasonic, where I was asked to put financial and operational controls into their first B2B sales business. That including at the end merging 3 separate entities and then turning that from a loss to profit. After that, I then moved into FTSE 250 and 100 environments, helping to transform traditional tech divisions into real solution providers. And a lot of the companies previously were sort of a technical team rather than a solution-orientated technical focus. That meant working across 22 autonomous business units, building an operating team of nearly 150 people, and learning the do's and don'ts of scaling quickly. Alongside that, I've been involved in startup initiatives from renewable energy to even an airport. But most recently, I was CFO, then COO of FONN, which was a SaaS platform for construction house builders. When I joined the business, it had a number of challenges, high churn, operational growing pains. By getting in and understanding each business area and then building an as-is view across each of the areas of that business, and then building a clear financial model and using data to focus on the right levers, we improved retention, grew ARR, and ultimately delivered a successful exit in May this year. I suppose I've been lucky to be able to develop my financial skills, but also to operate many other business areas, including developing and running sales functions, customer service functions, corporate governance, marketing, development, etc., but always underpinned by a foundation of my financial knowledge. So I would say if there's a theme across all of that, it's guiding companies through critical transition points, whether that's a turnaround, scaling up, preparing for investment or exit.
Before we get into Barclay Homes, you mentioned that Panasonic, you merged three divisions.
Yes.
Was that your first taste of pulling divisions together? Maybe not an actual merger, but
Yes, it was. That was an interesting exploit because we needed to put blue chip controls into basically a 22-year-old copier company. And so I think that was back in the late 90s. And around then, copiers was an interesting business, probably the best way to put it. I had 3 months to put the controls in place. And when I first put the stock controls in place, we couldn't actually sell anything because at that time they were avoiding some of the legislative requirements by being inventive as to the products they were selling. And when you put it into a stock inventory system, strangely, you couldn't sell the products that didn't really exist. But we did that, and there was a lot of challenge to start with from the incumbent people, but by clear explanation, sitting down, talking with them, explaining the reasons behind it, we created a very good, tangible team. And that initial company was the driving force behind actually turning the organization from loss to profit in the end.
Okay, fantastic. So moving forward to Barclay Homes, almost 20-year career there, moving up through the ladder up to the C-suite. Can you tell us more about that phase of your career?
Whilst I started at Barclay Homes, I've probably spent most of my career at Barclay Group. Barclays itself is an interesting business. It's built of a number of autonomous business units, and guided by the centre, but each business unit has its own targets and has to operate. effectively on its own. But for me, Barclays was invaluable experience. Whilst a very demanding organisation, the ability to learn and work with probably some of the brightest people I've come across was invaluable. Whilst it's FTSE 100 company, Barclays still had the ability to be agile to the prevailing economic conditions and markets. And I think that was probably where Barclays drives its success from. And that experience has really molded the person I am today and focused on clear financial planning and fast but considered action when required. It also taught me always to look ahead and have clear plans backed by a solid, realistic financial forecast. Let's face it, whatever the scale of your business, cash is king, and your investors, be them public or private, have not placed their hard-earned funds into your organisation for fun, but for a return. As an exec team, I think you have the responsibility to ensure each pound is utilised in the best way to enhance the business. If you keep that as a core philosophy, I believe it always guides you well. And if a multi-billion FTSE 100 that is highly successful works this way, then why would you think your startup or scale up can survive if your overheads get out of control? And I think if you always bear that in mind as philosophy, am I spending that pound in the best way? Then that guides your thought process into how you can run your business of whatever scale.
So on the note of delivering value for every pound spent, how was it operating in a public company environment and reporting quarterly to the market?
I think the one lesson it really taught me around that was around focusing on your return on investment. If Barclays itself was not a tech organisation at all, and within Barclays, one of the targets I got was to look at how that tech functioned operated. I went in on as a finance role, but I was asked to look at that and build a plan of how the tech function could operate for the organisation. And then I was asked if I could kick it off. That led to me working in that, delivering solutions for a business and really guiding it, how we used the relevant technology. And I think I'll always come back to that, relevant technology for your business. And I think that's as relevant now with AI as it is with any other technology that's been through in the past. It's what is relevant to your business, but being open-minded enough to look at that and say, okay, I'm not a tech business, but does this technology assist me? Does it add value? Does it provide me efficiency? And does it add a benefit to what I'm actually doing and how I'm doing it?
You're talking about efficiency there. Barclay Group's, you said each division was relatively autonomous. It sounds like that helped them grow faster. But was there any downside? Like, did they not have as much shared resource that other companies would have had? And
well, interestingly, the tech resource was, I divisionalized the tech resource when I was first there. I worked for Barclay Homes and for the guy who then became CEO after Tony Pidgley moved to being the chairman. And within that, I started off in a very divisional basis and took the drive for the use of technology into Barclay Homes. But following that, when I was asked to go over to group and run it in a more group wide, we then had to work with the divisions to go and talk to them, explain the benefits of centralizing and get buy-in. So a lot of that was really collaborative, explaining the whys and wherefores and the benefits to them and selling that internal solution to them of why that would benefit from moving to a central function. So we did end up as probably the only really central function in the organization, but that wasn't from a directive from the center. That was from looking at it realistically, what operated the business better, what provided them better and got them to buy into the concept of centralizing and investing in that central, because yes, there was a cross charge out from it. But we had to provide economic value for being a centralized team. We did very much the same with the digital. When I looked at the amount that was being spent through marketing, the cost of running everything standalone and each organization using different agencies was extensive, and then put a plan together to build an internal digital team, which we did successfully, which saved over £1 million a year for the organization and provided significant benefit to the marketing and lead generation.
Wow. So you had to, yes, you had to pretty aggressively sell it to each division rather than push it down as often happens.
Yes, which I completely agree with, because there's too many functions that are centralized, I think, in a number of organizations that don't have that value statement behind them. And unless it carries a value statement, why should people use it? If you're not able to provide that benefit and they can get it better externally, why should people use those internal functions? Yes, there's control in it. Yes, there's governance, but you need to deliver that governance and that control, but with benefits to the organization that are economically viable, not just have large cross charges that people have to suck up. But because that just leads to shadow IT. It leads to shadow services, because people will always go and get what they need. If they're responsible for running a profit center, why will they not go and get what they need? They may pay lip service, but it will cost you more as an organization as a whole. So why have an issue with being competitive with external? We always competed in the digital, on the design side and a number of other areas. We always competed, and we always got questioned every year. Why is there a value of having this internally and having the headcount? We had to justify that. But there's no issue with that, because you should be able to do that. But again, that's where the finance background comes into running those areas.
Yeah. So were you selling to the end user across the departments, or were you selling via finance of the division?
No, we sold to the end user directly. And within that team, which we built into a standalone division, I even brought customer service people in from the business, because we had to develop that customer engagement. It's all about customer engagement. Whichever business you're in, you've got to have happy customers. If you don't have happy customers, you're not going to be successful.
Yeah. Which reminds me, before we hit record, last time we spoke, you were talking about your investment in customer service and the customer service training. Can you talk to that?
Customer service to me has been a foundation of everything I look at. Since my days at Panasonic, they've run an excellent customer service internal project, which created the philosophy of both internal and external customers. Everyone you deal with, if you're a service element of a business or you're working with external clients, they're a customer, and you should treat them in the way that you want to do. So within Barclays and within the tech function, I put everybody through the Institute of Customer Service training, because that gives them a different concept of how they're operating. And I think it's incredibly important through any area of the business that there's clear transparency of the direction you're going in, and also delivering that service in a way that makes your customer happy. And that doesn't matter if they work in the same business as you or in a different business. I think the same philosophy is key, that you should be providing a service that you yourself will be happy to receive. And I think it drove some of the team mad that they had an end user running the tech team. But from that perspective, I think it's the right way to look at it, because you've got to deliver a product that your customer can operate and you can use, that's efficient and delivers value to them. Otherwise, why would they use it?
Yeah, absolutely. I think that's probably one of the areas that's most underinvested in, particularly in the B2B world.
I would say, yeah, I think customer service is an area that should be a high focus. Everyone looks at bringing revenue in and developing that top line, but it's retaining that revenue. You spend quite a lot of money acquiring new business. Your cheapest revenue is always your upsell or continuing business with the same client. So why not make sure that they're happy? Why not make sure that they see value from you being their provider of whichever service it is, and then gaining more from that? As a buyer of services, one thing that always drove me mad was spending a lot of time from both myself and the team explaining what our pain points were, and then people coming and trying to sell something completely different, and then finding out that they've actually got something that was relevant, but didn't generate as much income for the salesperson. You want people to listen to you and deliver what you need. And they're the organizations that you will partner with and continue to partner with, and will take you, be a far harder decision for you to leave, because that's what you're trying to do. You're trying to create a difficulty for them to leave you. There's always a what's in it for them. And if the what's in it for them is far weaker, why are they going to jump? Because jumping any service provider puts pressure on you. You've got to take change. You've got change into your business. You've got change into your operations, and that can be costly. If you talk to your customer, even if things aren't going right, and you're honest with them and you're open with them, then that will protect your revenue far better.
Yeah, absolutely. So moving on from Barclay Group to a next role, right, the other end of the spectrum, I think it'd be fair to say an SMB or a low mid-market company in FONN. Can you tell us about the journey there from when you joined?
I can. FONN was quite interesting. So for me, moving into FONN was very much about having a look at the current position. Whenever I go into any organization, I think there's always a desire to take what you've learned before and start making changes. For me, I think it's always critical to go in and perform that as is position across each area of the organization. Understand not just from the execs and the senior managers, but from the team. Where are we? What are we doing well? What are we not doing as well? What is our current position? And from there, then understanding from the exec team, what is the target of where you want to go? And then creating your as-is and to-be. So your as-is is, where am I now? What are the good things? What are the bad things? What could be amended? Here's where I want to go next in my to-be. And then your strategy is that progression from one to the other. But one of the key things that we tried to do there was to bring the team into that planning process and to understand from them, for them, whilst we developed from an exec level, what the goals and objectives were, the plans and actions to deliver that were also worked in very closely with each of the operational sections of the business so that there was buy-in. But I think the key thing is understanding where you are from that perspective, then drawing a very clear financial picture and a clear financial model, because unless you understand those areas and understand your forecast going forwards, then it's hard to understand what you need to do to achieve them. Anyone can put a spreadsheet together that shows brilliant performance. And I think it's always critical to have a 3-year horizon on that. Yes, when you get into years 2 and 3, it becomes more objective as to what you think you're going to do. But if you've got that rolling 3-year model and then you're comparing it back to your actuals of what you're actually achieving and seeing how that impacts, then you know what you're going to work with. But if you don't have that clear financial model and standing, then first of all, how do you know if you're going to make changes, what needs to be changed, first of all? Secondly, what impact is that change going to have? And thirdly, if you have got a gap, how are you going to fix it quickly? And that brings me back to the learnings from Barclays. Where are we? Barclays run very heavily on forecast. Actuals were sort of a secondary piece. They're sort of, are we near it or not? But what does it look like? What does that do to my future state? And that's how I've always looked at it going forward. What's my future state to a business? What are my actuals telling me? I can't change history. I can learn from it. And if I can learn from that history, then I can put the right things in place. But I think that also brings me back to what's key for CFOs. And it's not just numbers. It's about understanding each of those business units. How can you adjust a forecast if you don't know what impact in reality that's going to have? Because you can change forecast figures quite easily. We can all do that. But what does that do to the business? What does that do to you actually hitting the targets that you've got? Does that put undue pressure on the rest of the function, be it customer service, which we were just talking about? How are they actually going to deliver that service if you remove a head? Is it feasible for them to do that? Are the plans within that customer service team, have they got their own as-is and to-be targets? And are you just going to blow that up and ruin another area of your retention and increase your churn levels? So I think from a CFO perspective, it's really key to understand your business.
I was going to move on, but you're talking very interchangeably between finance and operations, which I think is great, and isn't always the case. So with FONN, it obviously in a pretty short period of time went on to a very strong exit to the Access Group. Can you tell us about the operational changes that were put in place to deliver that?
Yeah, again, from the as is and to be, the key things that we looked at first of all was around the output from the sales team was selling, but there were a lot of them. And one of the first things we looked at was what's the actual contribution once you take into account all your selling costs. So, for example, your marketing costs, your onboarding, your commission costs and everything else. What is the contribution per salesperson to your bottom line? Because you can have a lot of salespeople selling a lot of stuff, but if your contribution is incredibly limited or negative, what's the point in doing it? You're running a charity for salespeople, which is very nice, but if you're registered as a charity, you get much better tax breaks. And that's not the end result. What you're actually doing is investing in having lots of people there you're paying a salary to, but what return is that giving to your shareholders? Zero. You're just going to increase your cash burn and minimize your cash runway. So we looked at once we looked at the sales contribution, we looked at the marketing, we looked at the lead generation, we looked at how we were selling, we looked at the ACV, and we remodeled that. We looked at how we could sell differently. We moved from product to solution. And within that product solution, we looked at the lead areas and what we needed to spend on the marketing elements to create those leads. And whilst we reduced the sales team because the lead volumes didn't support the number of people that we had, therefore we were burning cash, we actually increased the ACV and the sales generation from the marketing spend that we had. So the cost per lead, cost per sale was, from a marketing perspective, we've reduced the marketing cost by probably 50%, but increased the lead generation to engagement and sale by around 45. So it was about repositioning the product, understanding the pain points and starting to sell to pain points rather than to functions and features. And once we could do that, then you can engage with people. It's a very different selling model when you're selling a feature. A buyer is looking at, okay, I might be able to use that, but can't see the picture. If you're selling a solution, then you're selling a cost saving into the future, and that adds value to the product. And the ACV started to increase, the revenue increased, our overheads were cut down, and we moved from the UK operation. We turned that round from by about 1.3 million in a 12-month period, just by looking at the basics. And that comes back to solid financial. Well, how much am I spending? What's it producing? And it comes back to, am I spending that pound properly? If I've got lots of people, I've got lots of revenue. And that was great in the past with private equity investment. People wanted growth, but today's market isn't that way. Today's market, people are looking at growth, but at solid commercial foundations as well. And you need to look at that business always from a point of, what do I need to exit, but what do I also need to continue my business running?
Yeah. And so it sounds like you got really strong unit economics after that turnaround. What was the exit process like from when you went to market?
The exit process was interesting because I think one thing people need to bear in mind through any exit process is, from an exec position and senior management position, you've now got two jobs. Not only are you running an exit process, but you've also got to keep your eye very closely on the day-to-day business. We had an experience in there where we were running through a previous, just before the Access one, we were running through a previous one. And within that previous acquisition, I was not comfortable with how it was moving forward, and our cash position was not looking great, but there was far too much, it's all going to be okay on the day. But your deal isn't done until it's signed on the bottom line. And I think within that, what we then had to change focus, or one of the pushes I had within that, was it may all come right, but it may not. We've got to look at the business today and ensure that we're in an operating position that if it doesn't, that you continue to operate properly. You cannot just hope it's going to happen. So I think the focus has always got to be, how do I continue to run my business efficiently, but also run the exit process efficiently at the same point. So you do have two jobs. And I think it's something people have got to keep in mind, that it's going to double your workload. And it may not be a success. Don't always presume because everyone's keen at the beginning. It's a bit like any deal. You don't go into every sale going, oh yeah, I'm going to win that, so the world's great. You're always building a pipeline. You're always building the future. So you've got to do the same with an exit.
Yeah. And how much external support did you have on the deal itself?
None really. It was all internal.
Okay.
So luckily at that point, I brought on a very good, while I was running as COO I came in at CFO to get an understanding of the business, moved into COO within the first sort of 12 months of being there, but we're still running the finance function. One of the things that was very clear was, having got to the sort of base level and getting good initial financial controls and visibility in place, that we needed a very solid and capable finance person in place. And I was very lucky to find somebody who's extremely good, who's still with the company at the moment, who actually provided that. And from there was a lot of long hours and work within there. But and there was stuff that we wished we had got done before we got into the due diligence process. So I think the learning from that is always be exit ready, but focused on continuing operations.
Yeah. Speaking of being exit ready, if you were to be parachuted into an organization and had to rebuild the finance and operations from scratch to be operating on the exit ready basis, what key things would you focus on, and what order would you do them in?
Coming back to what I previously said, for me, it's always critical being parachuted in, as to a extent I've been in a number of organizations, to perform that as is position with the overall team. Understand what you currently have before making any changes, because otherwise that can have detrimental impact. I think I've seen that happen quite a few times, and people try to change immediately in line with what they've done before. Often that leaves teams disengaged. They don't understand the reason behind it, the what's in it, and why, and concerned. I don't understand how you can change the present state if you don't change that present state without understanding it first. So for me, it's to get a firm grasp on the present position across all functions. Understand the stakeholders' wishes, be that the board, exec, other person, the 2B, model that, but then create that strategy and plan to take you forward. But as I said before, that's got to be inclusive with the team, as without empowering them to be part of it, they don't have a view of what direction you're in. And you can't benefit from the skills and knowledge. There's a lot of skills and knowledge in teams that isn't actually utilized fully. I've seen it across the board. Development teams is a one that I've seen far too often. Developers are incredibly clever, but if you don't explain the business to them, how do you expect to get the best out of them? And too often they're sat on the sidelines. But for me, I think it's to go in and stabilize, understand your cash runway, your unit economics, your contracts. If you don't understand these, you're sort of working in a fog. And again, you may have teams that are performing but not really contributing. How are you contributing to your bottom line? Is it the most efficient way that you can do it? Then build the visibility. Have a clear view of your next 3-year forecast based on your assumptions. Remodel regularly based on performance and market conditions. Get sight of your business through simple dashboards and KPIs so leadership can see what drives value. Without that, you're guessing. And you don't have to have lots of them. You can start small and say, okay, what are my key KPIs? And then as you get into it and understand that business better, you can extend those out, but never go so far that they become white noise. Strengthen your governance, lightweight, but it needs to be scalable. from that process. You don't want to put red tape in place to stop agility, but you do need some forms of governance so that you are in control of what's happening within your business. That's not empowering people, but it's having a governance process around it. And that then can scale as you scale. I've always been a believer in getting the foundations in first and then moving forward. If you build your house on sand, we all know what happens there. And then really invest in those value levers, customer retention in SaaS, margin in B2B. So really stabilize, then see what strengthens and then scale.
Okay. That's awesome. So keep it simple, roll out the basics and then go from there.
Yeah. As I say, this is why Barclays to me was such a good foundation. It had processes in place, but it was agile. And that for me was a massive learning experience. And that's something I'll always take with me, is keep that agility, because successful businesses are agile businesses. But you need to be agile and engaged and delivering the visibility of where you're going to your teams. If your teams don't know where you're going, it's like starting out on a journey saying, right, I want you to go there, but you can't have a map or a sat nav.
Yeah.
That adds stress, complexity, and takes a hell of a lot longer.
Yeah, absolutely. Absolutely. So you've told us what to do in terms of the how. If there's for all the emerging finance professionals out there listening, what tips would you give them in terms of how to get noticed, how to get more responsibility, and essentially how to get promoted at the top?
I suppose it's probably an older one. I would say, don't just be an accountant. Understand the strategy and value drivers behind your business. If you've moved into industry and you're not sat in one of the big four, then you need to understand the levers behind what you're doing and within that business. The better you understand that business, then you understand the picture that the numbers are painting. For me, producing a 3-year forecast is painting a picture of what it's going to look like, and you can sort of visualize your business through the numbers. But then you also need to understand the elements behind those numbers, and what any change is actually going to do, and is it going to impact you? You may say, right, I'm going to drop this cost of £20,000. That could impact you by 100,000 in a negative way. So really get in, understand the strategy of value drivers. Then learn to communicate, but understand how the story needs to be told to different stakeholders, investors, boards, and teams. There isn't a one-size-fits-all story. It needs to be presented in a way, and again, it comes back to selling. And I know you're saying to finance people, you've got to sell is a bit of an anomaly, but effectively, you're selling that financial position to different people. Different people have different drivers, and therefore you need to position it in an accurate and precise way, but aligned to what they're actually looking at and interested and need to understand. So it's learning to communicate in different ways to different stakeholders and different elements, and seek that cross-functional exposure. I think the best CFOs, COOs understand to a level sales, products, customers, and that is how you build that impact, understanding that impact to change to your forecast, and understanding the picture that you're painting with your future numbers in your financial business plan. And I think for me, the C-suite isn't about being the smartest person in finance. It's about being the person who makes sense of the whole picture. You can be brilliant financially, but if you can't communicate and you don't understand all those drivers, I don't think you make the best CFO.
Sales and communications, everything.
It is. Across business is about people. And unless you can communicate, service them properly and deliver results, then what are you doing?
Yeah.
I know it's a bit blunt, but
No, absolutely. Absolutely. Sales is everything. So I guess looking at it the other way, what main pitfalls are there to avoid, and what's the worst thing you see in your career?
I think it's coming back to exit. I think when we were going through that exit, a lot of people were very exuberant about it. It would all progress quite a long way. But I think it comes with experience. If your gut feel doesn't feel right, then you've got to ensure that if it doesn't go right, that your business is safe. And at that point, I don't feel, I think there are learnings from there that people were banking the deal before it had occurred. And at that point, I did put the heels in the ground. Luckily, I had a really good chairman. And behind that, we sat back and said, actually, yeah, it's a bit too much focus on the deal and not on the business. And from that, we need to ensure that we have the business in a good commercial position if this fails. And therefore, we sort of backed off a bit from the DD process, made sure that we were in a solid position, which was beneficial because when that initial deal did fall over, then we were in a position to carry on operating and then move into a successful acquisition. So it is always keep, and I think in today's market, it's making sure that your business is commercially viable yourself. Are we in a position where we are continuously reliant on raising funds and taking that risk because that's a gamble? Or am I in a position where I'm going to make raising funds easier because I'm improving the commercial bottom line? Can I become self-sufficient so that I can choose when I take it and what investment I take and what cost that is to me, that investment? And if I can move forward into that, then I'm in a far better position myself. So I think today, the days of, great, you've got a brilliant ARR growth. Yes, you're burning cash horrifically, but we'll still buy you. A high multiple have gone at the present moment. I don't think we're there anymore. So I think you need to have that controlled growth in place, but with a solid EBITDA and cash position going forwards.
Yeah, absolutely. It's easy to get money, investment or debt when you don't need it, and it's hard when you do.
Yes. Yeah.
Yeah.
And what do you have to give away? What happens to your cap table?
And so I guess on that note of the markets, looking forward, there's been a lot that's changing recently. Interest rates have changed in the past few years. Capital's changed. What investors look for has changed. The macro has changed. AI is changing how businesses are operating. What's your view of the market looking forward? What are private equity funds going to be looking for? And how can finance professionals take advantage of this in their own careers?
I would say in the UK, many private equity houses are sitting on aging assets at the moment because higher interest rates have slowed exits. I think the quick flip environment of the 2010s and up to sort of 2020 and COVID times have gone. Buyers are now much more cautious. I think similarly within Europe, we're seeing similar picture. Valuations are down, holding periods are lengthening. There's more focus on operational improvements than pure financial engineering. So I think companies must now show strong fundamentals, EBITDA, quality, cash discipline, predictable revenues to attract buyers or investment. And I think currently there's still macro uncertainty. I think in the UK, inflation is easing, but we're still above target. Rates are remaining elevated, and the housing market's been sluggish, especially if you're in construction or B2B supply chains. In Europe, energy prices and political fragmentation add risk. For investors, I think this still all means greater focus on resilience, proven business models, diversified revenues, and strong management teams. So it's coming back to running your business in a sensible manner. You mentioned AI. I think AI is reshaping expectations. UK companies are cautious and I think but curious. I think there are a number of boards asking what is our AI strategy and trying to understand it. Having been involved in tech, there's a lot of people who you go back to the digital marketing initially years ago and did people actually understand what it is? And I think it's similar with AI. I think AI is another technology, and we need to look at it. Comes back to relevance, and I think even if a business doesn't yet know the answer, I think finance functions are already benefit from forecasting, so and scenario modeling, automated reporting. I think areas are coming in. So yeah, I think it's key, and I think from an AI side of things, I think it's something that people have to look into sensibly for their business. I don't think you can ignore it. You'll end up with shadow AI. Most people are using a form of generative AI already. That will be used in your business, and if people see it's going to benefit, then they'll bring it in. As with all technology, even if you don't do it corporately and look at it and are open with what you're looking and why you're not engaging, people will still bring it in. So I think you need to look at it objectively. I think it's as with anything that could be a potential business benefit, you weigh up the pros and cons. I think that needs to be a clear communication that people understand throughout the teams within businesses. So if you don't feel it's right and you think there's risk, then communicate that, as long as it's logical. But I think it's an area which is going to grow. I think it's an area which can be highly beneficial in a number of areas if used properly. I'm not one that will ever sit down and look at technology and go, oh, that's great, let's try it. It comes back to, I think, the background of what's the benefit. It's an ROI piece. It's, okay, we can look at it. Where are we doing? Where could we potentially benefit from this? Where are the pain points in my business? Where do I feel I can get benefit from enhancing? And then what's the right fit of technology or otherwise to actually enhance where that part is of the business? It's got to come back to, okay, what's my business? What are my targets? What are my drivers? Where can I gain benefit? Where can I adapt, learn, be agile? But be agile with things like AI. Try, test, fail. Yeah, that failure is not always a bad thing. We all learn from history, and we all learn from what we do, and from failures can bring some really good results, because you will see things differently by trying and testing things. As you go in and apply new solutions, you'll maybe find it doesn't work, but it will also quite often generate a really good idea of how it could fit somewhere else.
Yeah, absolutely. So always start with the benefit and figure out why, rather than how can we use this cool new toy.
Yeah, rather than, as I've seen a lot, it's got lots of flashing lights and shiny buttons, let's give it a go. It's got to be worked from a business perspective. And where can that, and it comes back to the same basis. What are the pain points? And if you're selling AI, then what are the pain points you can resolve? I've been at shows where everyone was talking about AI, and then we were talking to people going on next, and they said, yeah, we don't do AI, but we're going to mention it because everyone else has. So it is the buzzword at the moment, and we've all seen that go through in the past. But I think it's incredibly beneficial in a lot of areas.
Yeah, absolutely. Well, Neil, this has been fantastic. You've given a lot of hugely valuable advice to everyone listening, and thanks for coming on.
Thank you for having me. It was very enjoyable.
Thank you.